Money Roots is made possible by the support of our sponsor, Rooted Planning Group. Are you ready to take control of your financial future? Look no further than Rooted Planning Group, your trusted partner in financial well-being. At www.rootedpg.com, you'll discover a wealth of resources and expertise to help you thrive financially. Rooted Planning Group specializes in personalized financial planning, investment management, and retirement strategies. They understand that every financial journey is unique, and they're here to guide you every step of the way. With a team of experienced advisors, Rooted Planning Group is committed to helping you cultivate a secure and prosperous future. Visit www.rootedpg.com today to learn more about how Rooted Planning Group can help you grow your money roots. Welcome to Money Roots, the podcast where personal finance gets personal. Each week, Amy and her guests dig deep into the world of finance, making it more approachable and understandable for everyone, no matter where you are on your financial journey. From savings and investments to budgeting and planning, we'll bring you practical advice, inspiring stories, and expert insights. We believe that everyone has the potential to grow a healthy financial future, and we're here to help you nurture it. So whether you're a financial guru or just starting to plant the seeds of your financial knowledge, this is the place for you. Get ready to uncover the tools and strategies that can help you thrive financially. So without further ado, let's dive into today's episode of Money Roots.
Hello, Money Roots listeners. Amy Irvine here, CEO and founder of Rooted Planning Group. Today, joining me is our CIO, which is Chief Investment Officer, Kerrie Beene, for us to have a quasi-jam session, I guess you want to call it, on the post-election market outlook, thoughts around this particular topic, some ideas what we're sharing in general, just for some education purposes. Of course, anything that we share with you cannot be guaranteed in any way, shape, or form. They're just thoughts that we have. And, we know that this is on a lot of people's mind right now. So we just thought we'd get together and kind of think it out loud, I guess you want to say, or think out loud and share some of our thoughts with you. So Kerrie, welcome to the podcast. Or should I say welcome back?
For sure. Welcome back. Been on here a lot lately.
Yeah. So Kerrie, I know that we have been over the last few days, it's basically been about a week, a little over a week as we're recording this, that, the election results have come in and we're trying to depict, what is policy going to be looking like? What are things going to look like in general under a second Trump term, and not just a second Trump term, but also a Republican House and Senate, right? So this is very different than the first Trump term. So in that respect, so I know you've done some research on this particular topic. One of the things that we did recently is we pulled together a sort of a market history based on what performances look like under various presidents since 1933. So we're looking back a pretty significant amount of time. What research did you find, kind of what's some of the data that goes along with that?
Yeah. So, I think the very first thing that stuck out to me is that, the market does what it does regardless of the political party in office. But the second piece that stuck out is that the market, they do like more of a balance than we've gotten. So that's one thing that, time will tell what that means for the market and for the economy. Those two things, I think the election can be a distraction, but it does, have some impact regardless. Looking forward. So we'll see. But that's the two things I think that were interesting in some of the research was political party isn't necessarily important always, but the market does sort of lack a little bit of balance for the most part.
Definitely. Yeah. One of the things that we pulled up was political parties and stocks with regards to what the average S&P 500 annual total returns by government control. This goes back to 1933, as I mentioned. It excludes 2002 and 2008 because those were aberration years, I guess you want to say. They were very significant declines on the market. Historically speaking, now this is just history. You know, we always want to say this is not political in any way, shape, or form. These are just numbers. But historically speaking, when a Democrat is in the White House, the market overall has performed at about 14.5%. So that's regardless of who's in Senate and Congress, or controls Senate and Congress. It's just if a Democrat is in the White House, the market performance has been about 14.5. Now, if it's a Democrat in the White House and it's a Democratic Senate and Congress, or Senate and House of Representatives, over the last 36 years, it would be about 13.6%. So when I say over the last 36 years, that means like during a 36-year period when it's like that, that the performance has been about 13.6. Now, when there's a Democrat in the White House and there's a Republican Congress and, so Senate and U.S. Representatives, it's about 18.2%. So that's that balance of power that you were talking about, Kerrie, out of all. And then if it's split, it's about 14.8%. So thinking about what I just said, when you have a Democrat in the White House, but your Congress is actually controlled by Republicans, that actually provided the best rate of return. Thinking about it from a Republican perspective, again, excluding 2002 and 2008, because those were significantly downward years. If a Republican is in the White House, then the market performed about 10.7%, excluding those 2 years. Overall, so regardless, like overall average was about 10.7. So if we're dating back from 1933 to 2024, then when a Republican is in the White House, the market has performed at 10.7 on average. If Democrats then control Senate and Congress, it's about 8.6. And if Republicans control the White House and Congress, it's about 16.8. So or 16.1. So about 2 percentage points lower than when Democrats are in the White House and the Congress goes controlled by Republicans. And then on the split side, if it's Republican in the White House and then it's split, so like one side is the House and one side, or Democrats are either the House or the Senate and Republicans are the other, then it's about 11.2, which is down just under 3%. So overall speaking, actually the market tends to perform, historically speaking, the best when a Democrat is in the White House and there's a Republican Congress. Now, that's not to say that it doesn't do well in other years. It's just the numbers tend to be higher when there's a Democrat in the White House. That's just, the numbers.
Yeah. Well, and I think the big takeaway is it's still in a positive direction. I mean, kind of regardless of what's going on, I think it's headed, for the most part, history isn't always a predictor of the future, but it's headed in a positive direction regardless.
Potentially. Yeah. So I guess that's one of the things that's important for people to understand is that, and we don't know, maybe this would be an exception to that rule. We have no idea, but those are the averages, because people often ask, what do you anticipate is going to happen? And we're like, well, if history is anything, if the future is anything like history, then we would expect, things to increase. In fact, one of the interesting facts that I found was that when we actually go back and look at the average annual total return, say 1 year after there is an election, if you look at that, and again, this is going back to 1933, average annual returns 1 year after for the Democrat side of things or Democrat presidency is about 12.1. And for a Republican presidency, it's about 13%. So that's the 1 year average lag, but yet the average annual return is about 14.5% for Democrat presidencies and 10.7 for Republicans. So what that says to me is that sometimes there is a little bit of pop, I guess, in the market the year after a Republican, slightly, it's 0.9% difference, right? Slightly more, but not that far off, really. I mean, when you look at those numbers and say 12.1% versus 13, that's not a huge variation. And again, these are all averages and just historical information. But when you look at the overall return, there's a little bit of a difference there. So again, going back to, we don't know if this is going to be a typical, cycle, but that's been some of the questions that I know I've been personally asked over the last couple of days are what should we expect?
Yeah.
And when you think about just from a standpoint of, like you said, the biggest thing that stands out to you is that when things really do well or the best, I should say, is when there's a balance of power. The overall market tends to do the best. Have you noticed any other trends that have been happening since the election?
I think, there's obviously a little excitement and emotion around a lot of it. And it did cause, I think it maybe increases the volatility a little bit. But overall, I think it's just that consistent theme of thinking long term and not getting tied up, in the short term. And I do think it's, one thing that's important is having a plan and a strategy that makes sense and reviewing your portfolio and thinking about how things are performing. But not getting hung up on the short term, kind of what's going on
right now.
Yeah.
I can't remember who wrote it or who said it, but we've repeated it many times. Markets move on a daily basis based on fear and volatility, but over a long-term basis, they move on growth and economic news. And I think right now there's definitely a lot of concern on all aspects of things, right? I just think there's a lot going on right now in general that people just have concerns on as a general rule. And I think one of the things that I've also heard a little bit about has been around bond yields. Now, I think it's important for us to take just a moment to talk about bond yields because this is always an area that people get so confused on around bonds. So when we have bonds, what happens just kind of take a moment to explain how bonds work. So you buy them, they have a face value, which is what things mature at. What happens when we have inflation? What happens to a bond that you currently hold when we have inflation? What happens to the price of a bond when we currently have inflation and the Fed raises interest rates?
The price of the bond goes down.
Correct. The price of the bond goes down. So in a period of time, going back to what I was originally asking, we've had some people say, I don't understand why bonds were so negatively affected by the election. Why are we seeing bond prices fall? When the idea is that in reality, if the Fed is going to continue to lower interest rates, they must think that the economy is slowing down. And yet bond prices significantly fell, even though the Fed didn't do anything and in fact didn't come out and say anything about interest rates until earlier this week. But why right after the election do you think that bond prices fell so much?
I think it's just the fear of the unknown. What's the new policies going to do? How is it going to, what are the tariffs going to do? It's just that fear of the unknown and
possible fear of inflation.
Yeah. And I think everyone kind of thought that, interest rates were going to be coming down maybe more quickly than now we think they are. So that, that kind of had a reaction in the bond market and changed things a little bit. So just I think the upcoming, new administration, we'll see if some of these changes are going to actually go into effect and what's going to happen. But I think the market's now saying, okay, if these things really do happen, what does that mean for the bond market?
Yeah. Are we going to see inflation rear its ugly head? And could that then affect the prices of bonds? And I think that they've reacted on exactly what I said earlier. Short-term reaction is on fear, right? So there's some fear that, great, our economy is going to grow, but are we able to actually absorb that at this point in time? is there going to be a pause? Because I think and this is just my opinion, but I think the stock market had priced in another rate decrease this year for 2024. And then based on some of this, some of the underlying fears, not just what happened with the election, but also some economic data that came out about September, that maybe things aren't slowing down as much as the Fed thought they were. So are they going to pause raising or lowering interest rates, or are they going to continue to lower interest rates? If the economy grows too quickly, are they going to then, turn around and start raising interest rates again? And bonds actually haven't recovered fully from the decline in 2022. They're still in negative territory when you look at a 3-year average. So I think there's just some concern on that front. In fact, in 2022, bonds were one of the worst performing, well, not worst, but they were down about 13%, considering that bonds as a general rule, even in a down market, are not down. Like if we look at 2008, in 2008, we saw the S&P 500 decline 37% and bonds were up 7.9%. And even the year prior to that, when we saw the S&P 500 up 5%, we saw fixed income. And so in 2007, we saw fixed income at 6.6%. So even in years where we've seen, I would say that they've been poor, bonds have been poor for performers and fixed income has been poorer performers, we generally don't see that kind of negative return on the fixed income side. In 2013, we did see a negative 2%. 2015, we only saw about 0.5%. But since then, it really, we haven't seen that kind of negativity. So in 2021, we saw a 1.8% decrease in fixed income, but then a 13% decline in fixed income. That's one of the biggest declines that we've certainly seen within a period since 2006, for sure. And, I went back and tried to do some research back even further, and I've just never seen a fixed income impacted like this before. So it's very interesting times on that front even. I know that we want to keep this relatively short in nature. Any other thoughts that you want to share? And I know you're going to be producing some stuff for clients to have information on as well and sending it out to them. But is there anything that you thought it would be important to share with folks as we sort of wrap up this podcast regarding this topic?
I think the two, again, and I hate to be repetitive, but understanding and educating yourself on a lot of it is really important, and knowing, that the short-term fluctuations may just be noise, and it is important to look at the bigger picture, but also don't ignore and put your head in the sand and just assume that, you're invested how you should be. I think it's really important to be aware and know what's going on, but not make emotional, decisions based on maybe noise, but make your decisions on facts.
Yeah. I think that's waiting for policy to actually be clearer before any major moves are made. Well, Kerrie, thank you so much for joining me today and having this conversation around things that people are very concerned about. We'll certainly be probably recording a few more of these over the next couple of months as we learn more and more, and certainly into early 2025, because that's when I think real policy will probably be laid out for us to try to figure out and interpret. And if you have any questions or would like us to cover a specific topic, please feel free to reach out to us at AskRPG or Ask Money Roots, and we'll be happy to try to record some additional topics on this. Thanks, everyone.
You've been listening to Money Roots, your go-to podcast for making personal finance accessible and approachable. Thanks for joining us today. Amy and her guests have enjoyed guiding you through the roots of your financial journey. Remember, whether you're planting new seeds of financial knowledge or nurturing the growth of your existing financial plans, Money Roots is here to support you every step of the way. Be sure to follow them on Facebook, X, LinkedIn, and Instagram for more resources. And, of course, subscribe to Money Roots wherever you get your podcasts so you never miss an episode. A big thank you to the sponsor, Rooted Planning Group, for making this show possible. At Rooted Planning Group, they're committed to helping you cultivate a thriving financial future. Until next time, keep growing your money roots.